Now, when Microsoft's first public country-by-country report showed that 38.1% of its global pre-tax profit was recognized in Ireland against roughly 6,600 employees there, the figure surprised no one who follows corporate structuring. What was new was visibility. Under the European Union's public country-by-country reporting regime, large multinationals must now disclose revenue, profit, tax, and headcount jurisdiction by jurisdiction. The disclosure is a useful entry point because it makes an abstract system legible. The purpose of this note is to explain the system on its own terms as capital flow infrastructure rather than scandal, and then to examine the jurisdiction at the center of the US corporates, Ireland. We look at why the structure exists, what it actually provides, what it earns the host country, and why the arrangement is more fragile and more contingent on external policy than the headline surpluses suggest. Think offshore financial centers are terminal destinations where foreign capital accumulates and effectively leads the taxable base, the traditional havens. Conduit offshore financial centers are intermediary jurisdictions through which capital is routed on its way to the sinks. They are attractive precisely because they look respectable. What a conduit provides is not merely a low rate, it's actually a bundle, a competitive statutory rate, a favorable regime for holding companies and intellectual property, an extensive network of bilateral tax treaties that trim withholding taxes on cross-border payments, robust legal certainty, and critically, a reputation for OECD compliance that lets a multinational extract profit from higher tax markets without the suspicion attached to a Caribbean address. Hello everyone, welcome back to our channel and welcome back to another edition of the Capital Insights series within Punjab Capital Research. Today let's talk about routing the profit, the tax havens as capital infrastructure, and the Irish case. So essentially, the tax havens that shape the global capital are not islands of popular imagination, but a small set of respectable treaty-networked conduit states. This note and this video reads the plumbing on its own terms and examines what Ireland's version of it earns and risks. Let's talk about the disclosure that prompted us to make this video in the first place. Now, when Microsoft's first public country-by-country report showed that 38.1% of its global pre-tax profit was recognized in Ireland against roughly 6,600 employees there, the figure surprised no one who follows corporate structuring. What was new was visibility. Under the European Union's public country-by-country reporting regime, large multinationals must now disclose revenue, profit, tax, and headcount jurisdiction by jurisdiction. The disclosure is a useful entry point because it makes an abstract system legible. The purpose of this note is to explain the system on its own terms as capital flow infrastructure rather than scandal, and then to examine the jurisdiction at the center of the US corporates, Ireland. We look at why the structure exists, what it actually provides, what it earns the host country, and why the arrangement is more fragile and more contingent on external policy than the headline surpluses suggest. So let's do a deep dive into the conduits, the sinks, and the bundle that matters. Now, the colloquial tax haven conflates two very different things. Now, popular attention fixes on zero-rate island jurisdictions. The load-bearing centers of the modern system are something else. A useful map comes from the University of Amsterdam's COPNET group, which analyzed ownership links across tens of millions of companies and split offshore financial centers into two functional categories. Think offshore financial centers are terminal destinations where foreign capital accumulates and effectively leads the taxable base, the traditional havens. Conduit offshore financial centers are intermediary jurisdictions through which capital is routed on its way to the sinks. They are attractive precisely because they look respectable. What a conduit provides is not merely a low rate, it's actually a bundle, a competitive statutory rate, a favorable regime for holding companies and intellectual property, an extensive network of bilateral tax treaties that trim withholding taxes on cross-border payments, robust legal certainty, and critically, a reputation for OECD compliance that lets a multinational extract profit from higher tax markets without the suspicion attached to a Caribbean address. The mechanism is usually intra-group charging. An operating subsidy in a high tax market pays royalty or fee to a group entity in the conduit for the use of intellectual property, shifting taxable profit from the former to the latter. The scale is material. Academic estimates of profit shifted into low tax jurisdictions run into several $100 billion every year, large enough to distort reported foreign direct investment, national accounts, and headline effective tax rates. Five conduits do most of the work. Now, by the COPNET classification, five jurisdictions perform most of the conduit function: Netherlands, United Kingdom, Switzerland, Singapore, and Ireland. And together, they route close to half of the corporate offshore investment. Each is specialized and each is tied to particular sinks. The Netherlands dominates the volume built around holding company structures. The United Kingdom's reach runs through its dependencies. A large majority of world sink jurisdictions are current or former UK territories. Switzerland pairs with Jersey, Singapore is the Asian hub connecting to Hong Kong and Taiwan, and Ireland is the principal conduit for United States corporates, with Luxembourg its historical backdoor. 2 points cut through the noise. First, routing share is a volume metric, not a measure of importance to any single corporate strategy. Ireland's raw share looks modest besides Netherlands, yet Ireland is indispensable to US technology and pharmaceutical structures that matter most to the reported profits. Secondly, the split between the conduit and the sink is a design feature and not an accident. It lets the multinational hold respectability at the conduit while still reaching a near zero terminal rate at the sink. This particular snapshot gives you the conduit, the share of the routed offshore investment, the primary paired sink, and the specialization. And you can see Netherlands being the highest, 23%, with the primary paired sink of Bermuda and the specialization of holding companies. Similarly, you have United Kingdom, Switzerland, Singapore, and Ireland with specific specializations out here. Next, let's try and understand as to why does Dublin sit at the center of the US model. Ireland's rise has some specific combination. The 12.5% headline rate is the advertised feature, but the durable advantages are surrounding bundle. An IP and a holding company regime built to attract intangible assets, membership of the EU single market, an English-speaking common law jurisdiction familiar to the US Council, a deep treaty network, and an unusually dense professional services ecosystem of law, accounting, and tax advisors. These mechanics have evolved under pressure. The double Irish, which routed royalties to a second Irish company tax resident in zero tax jurisdiction, was closed to new entrants in 2015 and fully phased out by the end of 2020. Its successor logic shifted towards onshoring the intellectual property into Ireland itself and claiming capital allowances against the intangible. The structure widely associated with Apple's 2015 restructuring, which moved a very large stock of IP onshore and produced a one-off 26% jump in the Irish GDP. Microsoft's continued use of the Irish hub rather than repatriating IP after 2017 US tax changes, as most of the peers did, is why its disclosure reads the way that it does now. The Microsoft filing is also a lesson in reading the country-by-country data. The profit-to-headcount mismatch is the structure signature. Profit is recognized where legal ownership and risks sit, not where the people are. But two figures demand care out here. Gross revenue reported under the country-by-country includes intra-group flows and so materially overstates external revenue. An internal payment from one subsidiary to the Irish entity is counted twice in the aggregate. And a single year's profit on tax can be distorted by acquisitions, restructuring, and resolution of multi-year audits. So essentially what the data illuminates out here is the structure. However, these are poor tools for precise comparison. Next, let's talk about the jobs, the spillover, and the sovereign wealth movement. Now, the arrangement is not costless theater for the host. It delivers concrete benefits, which is why Ireland defends it. They fall into two layers out here. The first is the real economy, wherein US multinationals directly employ on the order of 220,000 people in Ireland and anchor a wider ecosystem of suppliers, advisors, and spillover jobs. That base generates substantial income tax, social insurance, and consumption tax receipts that are genuinely tied to on-the-ground activity, distinct from the mobile corporate tax profits. Foreign direct investment on this scale has underwritten 2 decades of income convergence and has helped the domestic economy outperform much of the euro area. The second layer is the fiscal windfall, now the dominant story. Irish corporation tax reached a record of roughly $34.7 billion in 2025, having roughly tripled from the 2019 levels. The state has done consecutive budget surpluses while most of the European peers sit in deficit. The 2024 figures were further inflated by some $14 billion in back taxes from Apple following the Court of Justice ruling in the state aid case. Now, recognizing that much of this may prove transient, the government has been channeling part of this into two sovereign funds, a long-term future fund and an infrastructure and climate fund, effectively converting conduit states into sovereign wealth accumulation while the receipts lost. Now, being the US conduit has brought Ireland jobs, income tax spillover, and a surplus large enough to begin building sovereign savings. Let's also look at the fragility beneath the surplus out here. Now, the same figures that look like strength read differently are a concentration problem. The Irish Fiscal Advisory Council estimates that the three largest corporate groups account for close to 46% of all corporation tax, roughly 13 billion, and that foreign multinationals pay the overwhelming majority of the total. The identities are not officially confirmed, but the top players are widely understood to be two technology firms and one pharmaceutical group profiting from weight loss drugs. A base this concentrated is exposed to product cycles, leadership decisions, and structuring choices of a handful of companies. The Council's own adverse scenarios show exchequer sliding towards deficit if the receipts revert towards the 2020 levels. Now, there are two policy shifts that we are directly on the structure. The first is the OECD's 15% global minimum tax. Counterintuitively, it raises Irish receipts in the near term. A domestic top-up tax lets Ireland collect increments up to 15% itself, an estimated additional 5 billion or so. But almost all that is excess revenue unexplained by domestic activity, which deepens rather than diversifies the concentration out here. And the second and more consequential is the January 2026 side-by-side agreement. After the incoming US administration withdrew from the OECD project on the first day, the roughly 145-member inclusive framework agreed to leave US headquartered multinationals subject only to US minimum taxes, exempting them from the core Pillar 2 rules abroad. Ireland's domestic top-up obligations survive and full scope compliance still applies for 2024-2025, but the carve-out matters disproportionately to Ireland because so much of its base is US patented. It preserves a minimum tax floor while fragmenting the system into parallel regimes and reopens rather than closes the question of tax competition. Layered on top of this is US pressure on pharmaceutical and technology supply chains to reshore, with tariff threats already distorting the timing of Irish export receipts. In wrap-up, we can say that what's important out here is to read the trajectory correctly. The system is not being dismantled, it is fragmenting. A US carve-out sitting alongside the European minimum tax is a more complex map than either the race to bottom or its abolition, and the conduit jurisdictions retain both their treaty networks and their reasons to compete. That's all that we wanted to share with you in this video of Capital Insights. Stay tuned in for the next one.